Now, we heard there about recent woes in China. And is it now time to pull China out of the evaluation of global emerging markets and independently look at the prospects for both, as we do already in developed markets, where we split out the expectations for the US relative to the rest of the world? Now, no one better to answer that than our next speaker, Ian Beattie, who's co-CIO of NS Partners, and he's joining us, and he's going to talk us through what's been happening in the Ned Group Investments Global Emerging Markets Fund over the last 3 months, and what prospects they see for the category into the future. Good morning, Ian. How are you?
Good morning, Rob. Yeah, we're very well here. Yeah, very good. Thank you very much. Beautiful day in London.
Fantastic. Well, thanks for joining us, and I'll hand over to you now for your presentation, and we'll join you for questions. Just a reminder to everyone watching, if you would like to submit a question, apart from commenting on my new sharp haircut, if you'd like to submit a question, please do so in the top left-hand box, and I'll pose them to Ian at the end of his presentation. Over to you, Ian.
Great. Thanks, Rob. So I'm just going to give a quick overview of the last quarter, really, on the Ned Group Emerging Markets Fund. And yeah, that's great. So if we just kick off with the performance numbers, and I'll go from there. I'm going to rattle through this fairly quickly. So you can see there the returns. Obviously, it's been a tough quarter in the emerging market space. 1 year number to up 18.4% for the fund. Again, just marginally ahead of the MSCI Emerging Market Index with net dividends reinvested. So over a couple of years and since inception, we're a little bit further ahead, but the numbers are more modest. Now, as for the firm update, we've got $5 billion in the firm as of now, so we're probably what you call boutique and focused, with the emerging market strategy just over $2 billion. Continue to see strong interest and flows into the emerging markets product from around the world, actually, and as a result, we've been hiring more people on there. So if we go forward a couple of pages, I'm going to give you a quick summary. I think this is on page 4, if we can move that forward there. Great. And so this is the summary here for the third quarter on this. What worked? Well, we had good stock selection in India, in Russia, in the Philippines, and in Indonesia and Korea. Also positive on a relative basis was our underweights in China. We've been negative on China now for quite some time, Korea and Brazil. On the opposite side of that, our overweights in India, Greece and Thailand also paid us. On the sector side, it was all about stock selection in the staples and discretionary, but also real estate and communication services were also positive. But it didn't all work for us this quarter. We had some negative stock selection in Taiwan, which has been rare. This has been a very good source of alpha for us over the last few years, well, since inception. So we're giving up a little bit there after a very good run. And our underweights in the Gulf markets in Mexico didn't work this quarter either. And our overweight in Hong Kong offset some of that underweight in China a little bit. And obviously, although we've got very good stock selection in the energy sector, we didn't have enough of it. And the materials, well, we took profit a little bit too early in some of those material names, and that cost us this quarter. Now, if we highlight some of the real key important moves over this period, we've got Godrej Properties that had an outstanding performance this quarter. This is an Indian property developer and has a really exciting land bank, but the market sort of knew that. It had a really good sales momentum, which it wasn't the only property company that had that. But I think Godrej demonstrated not only good sales momentum in the recent results, but this period also showed they were replenishing that land bank in and around Mumbai in particular. And that's what makes this look like a really strong long-term investment, and the share price really did very well indeed. We've actually taken a little bit of profit in this already, but still own it. Shanghai Baosite Software is another company. So this is really closely allied with government policy. The Chinese are very concerned with their carbon footprint, and they're decarbonising large parts of the economy, even when these parts of the economy were big emitters up until now. So if you're going to try and run a steel plant more efficiently and try and run a steel plant so that it emits less CO2, then you need obviously modern steel plants, and you need really good software and systems so you can digitalize. And Shanghai Baosite Software does that. And then OPAP, a lottery company in sports betting, did very well in Greece as well. That economy is really doing very well at the moment. Our money numbers and our macro data looks very positive. On the negative side, we had some poor numbers out of Brazil. It's good to see these bouncing back a bit over the last few days, but this private sector bank, Banco Bradesco, had some poor results, not from the banking side, but from the insurance side in particular. And although we're underweight Chinese internet, we do have some Alibaba. And obviously, as I'm sure we're all aware, that's not been a good thing over this quarter. But we're holding in there for a number of the reasons that we've said already in this session that the previous speaker was talking about. We are underweight this sector, but we're actually looking to add to this sector. We think Alibaba's got a very strong franchise, and we think it's moved through the regulatory risk period now. So we're nearer the end of this than the beginning, and I'll talk a bit about that later on. Obviously, Win is hurt not only by the risks of a regulatory and more moral clampdown, but also COVID continues to make that a difficult business. What do we do over the quarter? Well, at the beginning of the quarter, we were continuing to add to India. We have stopped that. We're actually starting to reduce that as of now. And we reduced our underweight in China. We're continuing to do that. We're actually adding to China at the moment. I think that's the main thing for the summary, and I'm going to skip through this slide, which really shows our attribution by country, because I think I've covered most of that, but it is in here. If you want to see these materials, please just ask your Ned Group representative, and they'll make sure you get the full book and the full pack. So if we can go on to this, you can see the standout story of the quarter was energy. As we all know, that was a global phenomena there. I mentioned consumer discretionary is probably weaker in this area than many others. The Chinese economy is slowing dramatically, and there's obviously regulatory issues there as well. And I think that's all I'm going to highlight on this page. A little bit about security attribution. Well, we've mentioned the top three contributors here already. If we can go through to the next page, please. And I've mentioned the top few on here, and you can also see our consumer staples in India, Varun, and our healthcare name, Max Healthcare, doing very well. India's obviously been a great performer over this quarter, and those sort of mid-cap names doing really exciting long-term growth businesses in both of them doing very, very well. And Varun's been on the portfolio pretty much since inception, has been a very strong performer throughout that period. And as well as the detractors that we mentioned already, you can also see Alibaba Health information there. This is a stock that we've actually added to over this period, even though it's done very poorly. We think this is in line with government policy. Just because it's got Alibaba in its name doesn't mean that it's not working in line with government policy in the way the government wants the economy to develop. I'm just going to skip very quickly over the next couple of pages here. I think we'll pass that one for now. If we go on to the top transactions, and you can see on purchases, adding a bit to Korea here, and also companies like Flat Glass, very strong story here in the solar space and the structural growth, but also this business is showing very healthy metrics and some improvements there. On the sales, really, we were reducing things. We thought the regulatory risk has not peaked, especially at the beginning of this quarter. I think I'm going to go on to the macro now, because I think this will really, if we go on to the a few of the charts rather than these tables, because I think I've covered most of this now. We'll talk about why we're taking some of these positions. So we can go on to the chart on DM outperformance of emerging markets. It's actually, we're all beating up on emerging markets here, and I hate doing these charts, by the way, that are showing you something, you're charting something X, something else. It's almost like earnings before bad stuff when you're looking at a stock. But this one is actually interesting. You can see here that developed markets, X the US, are very similar. They've tracked very closely emerging markets, X China. Now, I don't think that tells you that much other than actually there are two standout performers year to date. One is the US for its outperformance, and the other is China for its underperformance. So I'm not doing this to say EM is actually okay if you strip out all the bad things, or DM actually isn't that exciting if you strip out all the really interesting US companies. But what I'm trying to say is, let's focus on where the big issue is. One is the massive outperformance of the US, and the other one is the significant underperformance of China so far in 2021. And what we can see is the reasons for this. Relative money trends were signaling that the US would be strong, but they have reversed. And they were signaling that the China economy would be weak. And I may be beginning to pick up signals here that this is starting to turn. It certainly looked like it's bottomed. So you can see on this chart on the right-hand side here that the blue line, the China chart, looks like it's bottoming here, and we're looking at more data to suggest that this might actually be the beginning of a China easing, long overdue, I might add. We might have to wait longer for a fiscal easing, but the monetary easing looks like it's certainly starting to counter the tightening that we've seen. And we think this will mean that the China economy is starting to bottom. And we all know what markets are like. All the rhetoric and all the excuses come in after the event and explain why what happened has happened. So are we about to get that in China? Now, obviously, we're not ready to do this too aggressively yet. We want some more data. But it would be very interesting, wouldn't it, if we get a turn in the monetary data for China at the same time as we have peak regulatory risk premium. Now, I'm not here to say that the regulatory risk premium is wrong and that it has gone, but I think it is definitely peaking here. And if it just comes back and resets partially, doesn't go back to where we all thought it was a year ago maybe, but if this was the peak and it just improved slightly, then obviously there'd be some significant upside for asset prices with both those things occurred at the same time. On to the next chart, because obviously we're all talking about Evergrande. Now, this Evergrande has been a very slow motion car crash, to use that cliche. We have all known this has been coming. Everybody has known this is coming. Evergrande is a very badly run company with way too much debt. You see these commentators saying the government pushed it over. Well, if they did, they just stopped people propping it up. They didn't push it over. This company should have gone bust a very, very long time ago. So they own a football club. They've been diversifying in so many different areas. It's ridiculous. And they've made terrible returns on capital, as well as having too much debt. You look at the chart on the left, though. Will it result in tighter credit conditions, which might offset any stimulus we're beginning to see? I know the jury is still out on this. We haven't got the data yet. But if you look at it, there's not many signs of distress yet. It looks very manageable. Certainly at the national level, China issued some bonds recently, and there was no sign of any increased risk premium. If you look at this one on here, it looks so far that there is no tighter credit conditions yet. And if you look at the PBOC Bankers Survey, that's the chart on the right, you actually see that it's improved. Now, the People's Bank of China has a lot more power over its banking system than many other central bankers. So it may well have told the bankers to lend more or to be a bit more relaxed about risks and expand credit. That is quite possible. In fact, I would say probable. But it doesn't really matter which tool they use if they've got more tools at their disposal. Is it happening? It looks like it is. I want to get a bit more data, but so far it looks like this is actually turning the corner. But structural risks are very difficult. They can, you can get tipping points, and that's why I'd like a little bit more data before we get too positive on China. But the time is coming when we will probably have to make a decision on this. what might get in the way of an easing? Well, unlike the rest of the world, it isn't inflation. If we go on to the next chart, please, you can see here, inflation trends are not an obstacle to easing. And again, that's something that you probably don't have if you're sitting in the Bank of England or the Fed at the moment. So CPI inflation is normal. The high PPI inflation, the high cost pressures that we've seen everywhere in the world because of the higher input costs has not been passed on to the consumer in China. Just shows how deflationary a force it has been for the rest of the world. And the balance of payments, if you look at the basic balance, it's in a large surplus. So there is no signs for worry on the exchange rate or capital account or balance payments front. Something else you always have to check on in emerging markets. This is a large country as well, remember. So if we go and look at what's happening in the rest of the world, we can see global industrial momentum is expected to slow further in 2022. Now, we're all talking about, oh, this is to do with maybe, last month we were talking about the Delta variant, and this month we're talking about supply side shortages. But our money data was saying the economy would slow. If anything, we might get some false readings on industrial output as the blockages start to clear. You can see very clearly when you look at, if you ever look at these maps about how quickly online, how quickly the throughput in the Chinese ports is cleared, and the waiting lists seem mystically lower than they are in, say, the US or in Europe. And that's because the Chinese ports work around the clock. They work all day and all night. Now, Biden has said they're going to work the big ports in the US around the clock as well. So we will see this backlog cleared. As it does, industrial output will probably pop up, but those commodity prices will start to fall. I suspect those input prices rather will start to fall. So watch out for some fake signals here, because that little pop in IP might be a fake one, just as the shortage is clear. Actually, it will be disguising the fact that demand looks like it's starting to lose momentum. So we're actually relatively cautious on economic growth going forward, and not just because of the cost pressures. If you look at the emerging markets cyclicals, they've been really weak. It's developed market cyclicals that have not been, which is quite interesting. So although we're negative on cyclicals at the moment globally, probably don't want to get too bearish on those emerging market ones. Just looking at some of the other macro charts, you can see real money growth is weak in Brazil, South Africa, and Russia, and we remain negative on those markets. But it is holding up better in Greece, hence our overweight, Korea, and Thailand and ASEAN are recovering quite nicely. Hence the fact that we have added to ASEAN markets in the portfolio. A big question, of course, remains on China. Is that one turning around too? And we're just getting ready, but we do want some confirmation in the data in case that Evergrande does have some second round effects. But I see very little systemic risk. But the trouble with systemic and structural risks is if they do occur, they are very big. So just want to make sure, get some more data to make sure this is okay, make sure policy is on an easing track, and then we will be looking to add to China quite aggressively. Just in summary, global industrial momentum is expected to slow further, as I said, into early 2022. The Chinese money growth was bottoming before Evergrande, and we're watching for this recovery to continue before we upgrade. But it's looking very close to us. We're looking on a relative basis. China's looking pretty good here. Regulatory risk premium is at an extreme, and we think it might come in. And we've got this potential easing of policy, certainly on the monetary side first. We're also warming up on other Asian markets, as I mentioned. The EM checklist, we've got this checklist about whether you should be overweight emerging markets or not. That is still mixed. So we're not banging the table in emerging markets here, but it is improving at the margin. And obviously we'll be very sensitive to any change in view on China, which we might have in the next week or month or so. I think the main thing to focus is that we've been overweight Southeast Asia, Greece and India, and underweight China, and maybe we're changing those last two. Maybe we're about to. South Korea, Brazil, South Africa, Mexico, we're still underweight. Although we're still focusing on quality companies with a high and improving return on invested capital, especially in China, where we still think there's some fantastic companies that we should all be putting in on our portfolios for the long run. These are going to be the real winners globally, I think, in the future. We're waiting for the signal to buy more China, but it could be getting quite close. And with that, I'm going to stop and see if we've got any questions. I know there's a lot of big issues out there in this space at the moment.
Thanks very much, Ian. And we do have one question that's come through, and unfortunately we're slightly out of time, but the question was to do with growth in emerging markets. What's the expectation for you have as a firm for growth? And are you positive, and how might that have a subsequent effect on assets?
Yeah, that's a very interesting question. I probably haven't got time to do it complete justice. We see a very broad range of growth going forward for different emerging markets. So China is obviously going to grow slower than it has for the last 20 years. I'm not sure that was the most important driver of share price returns, though, especially in China. We're much more focused on the returns on capital and the individual growth rates of particular companies, and they are significant. So we're more bullish probably on individual companies and therefore the stock markets within China than we are about the Chinese economy growing at the same rate. And that's because it will be a different type of growth, a different type of makeup. And that actually is the context in which you should see some of these China policy changes that everybody's been scared about. This could be a policy reset that could be very bullish for share prices in the long run after some initial pain. We've had reforms in other countries in the past as well. I'm thinking in particular in Germany a couple of times over the last 30 years that led to then significant bull markets afterwards and improvement in share price returns. This could be one of those moments where they're making sure that monopoly powers do not stifle innovation for the next group of leaders in their economy. I don't see that much evidence that Xi is particularly anti-private sector, which obviously is what everybody wants to throw at him. I can see evidence that he's a bit pro the SOEs. That's not the same thing as meaning that he wants to hurt the private sector. So I'm just going to throw that in there as well. That's the context. There are other frontier markets and so on like Vietnam and places like that. Obviously, it's very easy to be very, very bullish. India's done some strong structural returns, and I expect that growth rate to continue to improve going forward. But that doesn't mean that just because I've got a lower growth rate in for China going forward that I'm less optimistic on their share prices, because that's not quite the same thing.
Okay, thank you very much, Ian. Unfortunately, we have to stop there now, but thanks for joining us today and the insights that you shared.
Thank you, Rob.